Welcome back to the Deep Dive. Today we are digging into a really fascinating and I think pretty controversial company.
It's definitely one that splits opinions. We're talking about Natural Resource Partners. Ticker is NRP.
Right, NRP. And it's a master limited partnership in MLP, which already puts it in a special category. But the business itself sits at this weird intersection of, deep value, commodity exposure,
And a
and
whole lot of controversy because of its connection to coal.
exactly.
Yeah.
So at its core, what is NRP?
You can think of them as a capital-light landlord for the entire U.S. resource sector. It's a really simple but powerful model. They own a massive portfolio of mineral rights,
We're talking about something like 13 million acres.
a huge amount of land, and they don't do any mining themselves. They just lease that land out to operators.
So they're not the ones digging, they don't have thousands of miners on payroll?
Nope. They just lease the acreage for coal, for aggregates, oil and gas, you name it. The operators take on all the risk, the capital spending, the operational headaches, and crucially, the massive environmental liabilities.
And NRP just collects the royalty checks.
It's an incredibly high-margin, capital-light structure. And to add a layer of diversity, they also own a big stake, 49% in one of the world's lowest-cost soda ash producers.
Kiscam, Wyoming.
That's the one. So our mission for this deep dive is to figure out if NRT, with all its ties to coal, can actually be a compelling investment for a long-term, value-oriented investor.
And the story here, the real hook, is this incredible transformation they've gone through.
Oh, it's a night and day difference. If you looked at NRP back in, say, 2015, you'd see a company on the brink.
Drowning in debt, what was it, like $1.5 billion?
Yeah, about $1.5 billion. Leverage was over 5 times EBITDA. I mean, it was a classic crisis scenario.
But today?
Today, it's one of the most robust balance sheets in the sector. That debt pile has been crushed down to just $142 million. Leverage is almost non-existent, less than half a turn of EBITDA. And they hit a record for free cash flow in 2023.
Over $300 million.
$313 million to be exact. It's a dramatic, almost unbelievable turnaround.
Okay, but here's the paradox, and this is what we really need to unpack. Despite that financial discipline, despite the incredible cash flow, the market just doesn't seem to believe it.
Not at all. That skepticism is baked right into the valuation.
Which is what?
It trades at roughly 5 times its normalized free cash flow.
Wow.
Which basically implies the market thinks its assets are going to zero and fast. Or, look at it this way. If you value their 13 million acres of land, the current price works out to about $110 an acre.
That's nothing. So why the disconnect?
2 big reasons. First, ESG. A lot of funds just won't touch anything related to coal. And second, the MLP structure. That K-1 tax form is a headache that a lot of investors, especially institutions, just don't want to deal with.
So that's her central question for today. Can this huge free cash flow yield an asset-rich balance sheet overcome the fact that, well, coal is in secular decline, it's royalties over risk, but is that enough?
Yeah.
Let's start with the history to understand how they got here. To really get why NRP is so disciplined today, we have to go back to the beginning. It was formed in 2002, right?
Right, 2002. And it was built specifically to manage coal mineral reserves, mostly in Appalachia and the Illinois Basin. And it grew like crazy during that early 2000s commodity supercycle.
And early on, they made a really important structural change. Something about IDRs.
Yes, in 2010, they eliminated their incentive distribution rights, or IDRs. This was a huge, huge move for unit holders, even if it caused some short-term dilution.
Can you break that down for us? What are IDRs and why is getting rid of them such a big deal in the MLP world?
Sure. So IDRs are basically a profit-sharing tool. As an MLP grows its cash flow and crosses certain distribution thresholds, the general partner, the GP, starts taking a bigger and bigger slice of the pie.
A disproportionately high slice.
Exactly. Sometimes up to 50% of any new cash flow. It creates this inherent conflict of interest between the GP and the regular common unit holders. It's like a tax on growth.
So how did NRP get rid of them?
They did a swap. They issued 32 million new common units to the GP in exchange for the IDR rights. Now, that was dilutive at the time, but what it did was align everyone's interests perfectly. The GP suddenly owned a huge chunk of the common units.
So their success was now tied directly to the common unit holders' success.
Precisely. It was a really smart long-term governance play. The irony, of course, is that they fixed this structural risk right before they took on a massive amount of financial risk.
Right, the boom years. They were known as a yield machine, paying out these massive distributions.
Oh, yeah. We're talking $22 a unit annualized at the peak. It attracted every yield chaser on the planet, and that's when they made their big mistake.
The ill-timed diversification.
Classic late cycle behavior. Right at the peak of the commodity cycle in 2013, they went on this aggressive debt-funded acquisition spree. They spent about $365 million.
And this was almost all new debt, right? High-interest stuff.
Yep. They issued 9.125% senior notes. I mean, they just loaded up the balance sheet.
The idea was to diversify away from coal, which on the surface sounds pretty smart.
The strategy was sound. The timing and the financing were catastrophic. The biggest piece of that was the $293 million they spent on the 49% stake in the OCI Wyoming soda ash business.
A great asset.
A fantastic world-class asset. But they bought it with borrowed money just months before the entire coal market completely imploded. They left themselves with zero margin for error.
And then came the collapse, 2014 to 2016. What was the trigger?
A perfect storm. Natural gas got dirt cheap. New regulations came in, and U.S. thermal coal demand just fell off a cliff.
And their customers, the miners, started going bankrupt.
Exactly. Major lessees, like Foresight Energy, went into bankruptcy. Suddenly, the people who owed NRP money were in serious trouble.
And because of all that debt they took on in 2013, they were caught in a leverage trap.
Caught completely flat-footed. That $1.5 billion in debt pushed them way past 5x debt to EBITDA, and the unit holders felt the pain immediately. The distribution was cut by 74% in one quarter. And then it was slashed again, down to just a token payout. Meaningful distributions just stopped for 6 years. The unit price collapsed from over $100 down to low single digits. It was an absolutely staggering destruction of value.
It sounds like a complete failure of management to stress test their own balance sheet.
It was. They prioritized high distributions over a prudent balance sheet, and they paid the price. The core lesson here, which became the bedrock of their new philosophy, is that you cannot run a cyclical business with that much financial leverage.
So how did they survive?
They had to get rescue financing just to stay afloat. In 2017, they issued $250 million of new preferred units that paid a 12% cash dividend.
12%? That's expensive money.
Extremely expensive. But it bought them time. And then came the leadership change.
This is when Craig Nunez stepped in.
Right. The former CFO elevated to president and COO, and his mandate was crystal clear and, frankly, painful. Survival over everything. Deleveraging over distributions. It was the only way to save the partnership.
But here's what's so amazing. Even in the worst year of that downturn, 2016, with miners going bust left and right, NRP was still free cash flow positive. How is that possible?
That right there shows you the power of the royalty model.
Right.
A mining operator is bleeding cash in a downturn. They have huge fixed costs. Labor, fuel, maintenance. NRP has almost none of those.
And they have those minimum payments in their contracts.
That's the key. Many of their leases have minimum royalty payments. So even if an operator slows down or stops mining, NRP is still contractually guaranteed a floor payment. That structural advantage is what kept the business alive while the balance sheet was on life support. The business model was sound, the capital structure was just deeply flawed.
Okay, so this near-death experience completely reshaped the company's identity. This is the beginning of what you call the Nunez Mandate, the decade of austerity.
It was a total cultural reset. They adopted this ultra-conservative, glass-half-empty mindset for everything. They created this rigid checklist for capital allocation, and it governed every single dollar that came in the door.
And what was on that checklist? What were the priorities?
Simple and non-negotiable. Priority number 1, retire debt. Priority 2, get rid of that expensive 12% preferred equity. Priority 3, extinguish all the dilutive warrants they'd issued.
And only after all of that was done could they even think about raising the common distribution.
Exactly. It basically guaranteed years of austerity until the balance sheet was pristine.
And we saw that discipline in the distribution. They held it at that token, 0.45 cents per unit, for 20 straight quarters.
Yeah.
That takes some serious conviction, especially for an MLP.
It does. I mean, in the MLP world, cutting your distribution is usually a death sentence for management. But they held the line. They were sending a clear signal. Long-term solvency is more important than short-term yield.
And it wasn't just about paying down debt. They got really lean operationally, too.
Absolutely. Corporate overhead was slashed. They run the whole enterprise with about 55 outsourced employees. Think about that.
Teddy?
And compare their activity. Before the crisis, they were spending a couple $100 million a year on acquisitions. After the crisis, they went almost 7 years with 0 acquisitions.
That's a profound shift.
It is. Management even went on record saying that if they started making big acquisitions again, investors should see it as a red flag, a return to empire building.
Wow.
They were completely focused on value extraction, not growth for growth's sake. They even kept a $100 million cash buffer on the balance sheet as an insurance policy.
So let's talk about the results. By 2022, what did this austerity actually achieve?
I mean, the numbers speak for themselves. They paid off something like 90% of their long-term debt since 2015. Debt went from that $1.5 billion down to just $142 million by the end of 2024.
And they got rid of that expensive preferred equity.
Yep, that was a huge step. They fully redeemed it by mid-2024, which instantly freed up $30 million a year in dividend payments. They also cleaned up almost all of the warrants, simplifying the capital structure.
And I imagine the credit markets took notice.
Oh, for sure. Their leverage ratio just collapsed from over 5x down to well under 0.5x. That gave lenders the confidence to upsize their revolving credit facility, which, of course, they've kept completely undrawn.
So the signal that the repair phase was over and the harvest phase was beginning, that came in 2022.
That was the turning point. They announced the first distribution increase in 7 years, from $0.45 to 75 cents a quarter.
And then in 2023, they started paying out special distributions.
Exactly. They paid a massive $2.43 special distribution in 1 quarter alone. That was the definitive signal that the years of pain were over. The partnership was now in harvest mode, and it was built on a foundation of solid rock, not sand.
All right, so we've covered the history. Let's dig into the actual business model today. It's really a dual-segment company, mineral rights and soda ash.
That's right. And the mineral rights business is the big engine, historically making up the vast majority of revenue.
And this is where that royalty structure is just so powerful.
It's the whole secret sauce. NRP owns the land and the minerals, they lease it out, and they collect a royalty, usually 5% to 8% of the sales price, but they have almost zero operational costs.
Because the lessee, the operator, bears all of that.
All of it. The development costs, the labor, the fuel, and this is the big one, all of the environmental liabilities. The reclamation costs at the end of a mine's life are massive, and NRP is shielded from that.
So when you look at their margins, they're just on another planet compared to an actual mining company.
It's not even close. An active miner might have EBITDA margins of 15% or 20%. NRP's EBITDA margins often run over 80%.
80%?
Yeah. And their free cash flow margins are regularly north of 70%. It's because almost every extra dollar of revenue drops straight to the bottom line. Their only real costs are some fixed G&A and a tiny, shrinking interest expense.
And their contracts have those downside protections built in.
Yes, the minimum royalty payments. That's their insurance policy. It's why they stayed cash flow positive in 2016 when their customers were going bankrupt. It's a critical part of their structural moat.
Okay, let's talk about the other pillar, soda ash. This is their passive 49% stake.
Right. This is their diversification play into industrial minerals. Soda ash is critical for making glass, detergents, and now it's a growing component in solar panels.
And their asset, Siscam, Wyoming, is a top-tier producer.
It's one of the lowest-cost natural producers in the world thanks to its location in the Green River Basin. That gives it a huge advantage over synthetic producers, especially in Europe and Asia. NRP just gets a check for 49% of the net profits.
So let's break down the coal business, because it's not all the same. It's really a two-speed world between met coal and thermal coal.
That's a great way to put it. Metallurgical, or met coal, is the real value driver today. It's what's used to make steel.
So it's tied to global industrial production, not power generation.
Exactly. The demand is driven by steelmaking, especially in Asia, so it doesn't face the same kind of terminal decline pressure as thermal coal. The investment thesis for their met coal assets is really a leveraged bet on price. The supply side is very constrained, so when demand is strong, prices can spike dramatically.
The higher price for a lower volume scenario.
That's the idea. Now, thermal coal is a completely different story.
That's the one used in power plants. The wasting asset.
It is, and to their credit, management is very blunt about this. They've said publicly they expect revenue from their domestic thermal coal assets to eventually go to zero.
So when you're valuing the company, you have to treat that as a finite annuity that's just being harvested.
You absolutely have to. Any terminal value you assign to that part of the business should be zero or very close to it.
And the soda ash market is showing its cyclical side right now, which is a big risk.
A huge risk. While it has great long-term drivers like solar, the market is currently swamped with new supply from China and Turkey. That, plus weak global demand, means prices have crashed.
And NRP got zero distribution from the JV recently.
Zero in Q3 of 2025. It's a stark reminder that even a world-class asset can be highly cyclical, and NRP has to be able to weather these downturns.
So the real competitive moat here isn't brand or tech. It's geology and contracts.
Exactly. The assets themselves are irreplaceable. 13 million acres of mineral rights. And they have this unique asset, 3.5 million acres of underground pore space.
Which brings us to the carbon sequestration pivot. This is their long-term optionality play.
It is. They're trying to leverage that pore space, which is perfect for storing captured co-euro, and they're doing it in a classic NRP capital-light way.
They're being the landlord again.
Exactly. They leased out some of this space to partners like Occidental and Denbury. The partners take on all the billions in capital risk to develop these carbon storage hubs, and if it works, NRP just collects a royalty on every ton of co-aero stored.
But we did see a recent setback there. Oxy canceled its lease in Texas.
We did. And that just highlights how difficult and uncertain the carbon capture industry is right now. It's a setback for the industry, but for NRP, it wasn't a financial disaster.
Because they didn't spend the capital.
Right. They can just patiently wait and see if the technology and the economics ever make sense, and if they do, they're sitting on a potential gold mine. It's a free call option on the future of decarbonization.
Okay, let's connect these structural advantages to the actual numbers. The unit economics here are driven by this concept of near 100% incremental margin.
And that creates this incredible cash flow leverage. Because NRP's cash costs are so low and so fixed, you're talking maybe $30 to $40 million a year in G&A. Any change in commodity prices flows almost directly to their free cash flow.
Let's walk through an example of that.
Sure, look at 2022. Met coal prices basically doubled. What happened to NRP's free cash flow? It more than doubled, jumping from $123 million in 2021 to $268 million in 2022.
That is massive leverage.
It's extraordinary. Of course, it cuts both ways. When prices pulled back from the 2023 peak, the free cash flow dropped proportionally. It's a high beta play, but one where you're shielded from all the operational costs.
And the fact that they have basically zero sustaining capital expenditure, that's a game changer.
It really is. Most industrial companies have to reinvest a big chunk of their cash flow just to stand still, just to maintain production. NRP doesn't. The lessees do all of that.
Which means their free cash flow conversion is just off the charts.
It's almost peerless. That's why for this company, you have to focus on free cash flow. It's the truest measure of the value being generated.
So let's put some per unit numbers on this.
Yeah.
At the peak in 2023, what was the FCF per unit?
In 2023, they did $313 million in free cash flow with about 12.5 million units outstanding. That works out to roughly $25 per unit.
$25 per unit in cash flow. And even in a more normal year like 2024, it was still very strong.
Yeah, in 2024, it was closer to $20 per unit, still incredibly robust.
Okay, now contrast that with what they're actually paying out as a distribution.
This is where the valuation disconnect just smacks you in the face. Their current distribution is $0.75 times a quarter or $3 a year.
So in a year where they're generating $20 of cash, they're only paying out $3.
Right. It's a payout ratio of less than 20%. It's incredibly conservative. Management is signaling they have a mountain of cash, and the market is signaling that it doesn't believe that cash flow is sustainable.
Which is why you get this FCF yield of, what, 10 to 12% even on the lower, more recent cash flow numbers?
Yeah, that kind of yield is screaming that the market sees a value trap. It's pricing in a collapse. But when you look at the management execution and the resilience of the model, you have to wonder if the market is being overly pessimistic.
And the story of de-risking here is really the balance sheet. Let's just quantify the impact of that debt elimination.
It's profound. Debt is down from over $600 million in 2018 to just $142 million now. The preferreds are gone. And think about the interest savings.
It's huge.
They used to spend $70 to $80 million a year just on interest, money that went to bondholders instead of unit holders. Now that number is down to around $12 million.
So they've essentially eliminated the financial risk that almost killed them.
They have. Leverage is under 0.5x EBITDA. They're on the verge of being a debt-free company in a very volatile industry, and that gives them immense flexibility. That extra $40 or $50 million a year they're saving on interest and preferred dividends can now go straight to unit holders. The vulnerability is gone.
So NRP's playbook for the last decade has been all about debt retirement. No reinvestment was the mantra. But that chapter is closing. So the big question now is, what do they do with all this cash?
And that is the central capital allocation debate for the company today. Their disciplined playbook up to this point has been flawless. They were opportunistic, buying back their own debt at a discount during the crisis.
And redeeming that 12% preferred equity was a no-brainer.
It was a guaranteed 12% return on their capital. You can't find a safer, higher return than that. It saved them $30 million a year.
And even their big strategic pivot into carbon sequestration has been done in a capital-light way.
That consistency is so important. With the Oxy and Denbury deals, they acted as a landlord, letting their partners take on the massive, risky development costs. It proves they've learned the lesson. Avoid big, debt-fueled growth projects.
Okay, so that brings us to today, the post-deleveraging debate, harvest mode. With the debt almost gone, how do they maximize value for unit holders? Is it higher distributions or is it unit buybacks?
It's a classic dilemma, and the argument for buybacks is incredibly compelling right now.
Because the units are so cheap.
Exactly. When your stock is trading at 5 times free cash flow, buying it back is hugely accretive. Every unit you retire makes the remaining units more valuable. It's a great use of cash.
But there's a strong counter-argument.
Right.
Based on the nature of their main asset.
A very strong one. The other school of thought says, look, your main asset, coal, is in secular decline. It's a melting ice cube. So why would you use cash to buy back shares in a shrinking business?
The argument being just give the cash back to the unit holders.
Right. Distribute 100% of the cash flow and let the investors decide where to redeploy it themselves, rather than trusting management to manage a declining asset base.
And you have to factor in the huge insider ownership here. The GP, the Robertson family, owns a massive stake.
They own 25% to 30% of the common units, and an ownership stake that large naturally creates a bias towards high cash distributions. They want the partnership to be a cash machine, not a growth platform.
So if NRP decided to, say, target a 50% payout ratio, what kind of yield are we talking about?
Well, if they're generating $20 a unit in a normal year, a 50% payout would be $10 per unit. Even if you use a more conservative FCF number, they could easily support a $6 to $8 annual distribution.
Which would be an 8 to 10% yield on recent prices.
A very high immediate yield. And it shows you the capacity they have to return cash.
This all comes back to what you call the anti-empire building ethos.
Yeah.
They have to stick to the plan.
That is the single most important factor for an investor's trust. Management has publicly committed to this harvest and return strategy. Any deviation from that, a big splashy acquisition, would be a major breach of faith. It would be an instant sell signal. Their job now is simple. Run the assets efficiently and send the cash back to the owners.
Okay, let's talk about management quality. When a company goes through a near-death experience and comes out the other side stronger, you have to look closely at the leadership. How do we grade their execution since 2017?
I think you have to give them an A+. The track record is just exemplary. They laid out a clear plan, reduce debt, eliminate preferreds, clean up warrants, and they executed it perfectly. That builds a ton of credibility.
And they also managed through some very tough situations with their customers, like the Foresight Energy bankruptcy.
That's a huge point. Usually when your biggest tenant goes bankrupt, you're in big trouble. But NRP was proactive. They renegotiated the agreements. They secured fixed payments to keep the revenue streams alive instead of just losing the asset. It was very pragmatic.
And I appreciate their transparency. That's not always common in the commodity space.
Their candor has been a real hallmark. They've consistently adopted this cautious, glass half-empty tone. A perfect example is their 2023 annual letter.
Right, when they basically told investors not to get used to the record cash flows.
Exactly. They came right out and said that the numbers were unsustainable and would decline as commodity prices normalized. That kind of honesty manages expectations and builds long-term trust.
So let's talk about alignment and governance. The high insider ownership is obviously a big positive.
It's the primary check on any governance risk. When insiders own 25% to 29% of the company, their financial interests are directly aligned with yours. Plus, their incentives are tied to FCF generation and debt reduction, not growth. And of course, they got rid of those conflicted IDRs years ago.
But there is a governance quirk in the MLP structure. Unit holders have very limited rights to remove the general partner.
That's a structural risk you have to accept with many MLPs. It takes a supermajority vote, and you have to prove cause, which is a very high bar.
So what keeps the GP in check?
It's that massive ownership stake. The GP would be harming itself just as much as minority unit holders if it made poor decisions. In this case, the financial alignment really trumps the legal power structure.
What about related party transactions? That can be a red flag in some MLPs.
It's something to watch, for sure. The GP gets reimbursed for management services through affiliates, and those fees run around $11 or $12 million a year. But the research suggests those costs have been stable for a decade and appear to be at cost. We're not seeing any signs of egregious sweetheart deals here.
And finally, let's go back to the execution on their transition initiatives. The carbon sequestration deals were proactive, but the Oxy setback was real.
It was, and it shows that the road for carbon capture is going to be bumpy. But again, you have to look at management's execution style. They secured these massive deals without committing a dime of their own capital. They are patient landlords. The Oxy cancellation was a reminder of external market risk, not an internal failure of capital allocation.
All right, we've built a pretty strong case for the company's financial health and management quality. Now we have to get into the really tough stuff, the risks. And the biggest one is obviously commodity price volatility and the secular decline of coal.
This is the central risk. This is what you're betting against. The cash flow is highly, highly sensitive to prices. We saw FCF drop by $9 million in a single quarter recently because met coal was weak and the soda ash distribution went to zero. You can't forget that thermal coal is on a path to zero. The entire thesis rests on met coal holding up long enough for them to return all this capital.
And then there's the risk of just running out of the asset. Reserve depletion, mine closures.
These are finite resources. They're being dug out of the ground every single day. If a major mine complex run by one of their key lessees has a geological problem or an accident and has to shut down early, that revenue is gone. And it can't be easily replaced, especially since management has promised not to do big acquisitions.
Which leads right into the next big risk. Counterparty concentration.
This is a big one to watch. Just two companies, Alpha Metallurgical and Foresight Energy, made up 43% of their revenue in 2022.
43% from two customers.
Yes. So if either of them gets into serious trouble, and remember, Foresight has already been through bankruptcy once, it's a direct material threat to almost half of NRP's cash flow.
And we've already touched on the soda ash market glut. The fact that distribution went to zero is a serious data point.
It is. Management has said they expect this oversupply to last for the foreseeable future. That means investors have to be prepared for NRP to rely almost solely on its coal royalties for cash flow, maybe for several years. The diversification benefit is on hold right when they might need it most.
Let's talk about the structural risks.
Yeah.
The MLP structure itself holds down the valuation.
It absolutely does. The K-1 tax form is a barrier for a lot of investors. It keeps many institutions and ESG funds on the sidelines, which caps the demand for the units. And there's always the tail risk that Congress could change the tax laws for MLPs.
And there's that limited call rate you mentioned, the GP's power.
This is a latent but real risk. The partnership agreement allows the GP to buy out all the common units if it acquires 80% or more of them.
And they're already at, what, 50%?
Around 50%, yes, through various entities. So that 80% threshold isn't that far off. It means if things go really, really well, the GP has the option to take the company private at a price they choose, which could cap the upside for minority investors. It's something you have to be aware of.
So let's put these risks in context. How does NRP stack up against, say, an active coal miner like Arch Resources?
This is where NRP's structural advantage really shines. An active miner faces a mountain of operational risks. Labor strikes, accidents, cost inflation that can turn margins negative in a heartbeat. NRP has none of that. It won't bleed cash if prices fall. NRP survived the 2016 crash. The miners went bankrupt.
But a lot of those miners, like Arch, are also debt-free now.
They are, which is great. The difference is in the fixed cost structure. In a severe downturn, miners still have to pay for labor and equipment. NRP's only real fixed cost is its tiny G&A. They have a much higher margin of safety against having to take on new debt in a slump.
And how about against a pure-play soda ash producer, given the glut?
NRP's position is much safer. Through CSCAM, they are a low-cost producer, so they'll be the last ones to shut down. But more importantly, NRP's overall solvency isn't threatened if the soda ash distribution stops for a few years. A pure-play producer with leverage doesn't have that luxury.
Okay, so let's boil this all down to the kill criteria. What are the red flags that would tell you the investment thesis is broken?
Number one, without a doubt, is if management abandons the cash return focus, a big unexpected acquisition, or a decision to retain a bunch of earnings for some new growth project. That's an immediate sell signal. It means they've forgotten the lessons of the past.
Number two would be if the core business falls apart faster than expected.
Right. If met coal volumes start declining by more than, say, 5% a year consistently and prices don't make up for it, then the cash flow projections are busted. The whole thesis depends on that met coal annuity being durable.
And finally, an unjustified distribution cut.
Exactly. Once the debt is gone, if they cut the distribution and it's not because of a clear collapse in commodity prices and they're not using that cash for a huge accretive buyback, That's a major red flag. It would signal that something is wrong with the assets or that the GP is no longer aligned with common unitholders. That's when you head for the exit.
So that concludes our deep dive into natural resource partners. We've found a company that has pulled off an incredible financial turnaround. They've gone from being crippled by debt to being on the verge of debt-free.
And they're generating exceptional free cash flow because of that capital-light royalty model. But the market valuation remains deeply, deeply suppressed because of the stigma around coal and the complexity of the MLP structure.
It's really a case study in crisis management and disciplined capital allocation. Let's wrap up with the four most critical takeaways for you, the listener.
First, safety and de-risking. The financial risk that almost killed the company in 2015 is gone. They now offer one of the safest balance sheets you can find in the high-risk commodity sector.
Second, the FCF harvest. Management is highly aligned with unit holders and has explicitly committed to a strategy of returning cash. NRP is set up to become a major capital return vehicle with the potential for double-digit annual yields.
Third is the structural advantage. That royalty model is pure genius in a cyclical industry. It insulates them from the operational risks, the capex burdens, and the cost inflation that can bankrupt their mining peers. It's built to survive.
And fourth, optionality. The high-quality soda ash business and that vast untapped acreage for carbon sequestration give them call options on the future. They provide diversification that pure-play coal companies just don't have.
So here's the final provocative thought I want to leave you with. Given that the market is pricing NRP as if its assets will be worth less in just 5 to 7 years, you have to ask yourself this question. If management just sticks to the plan, if they just operate as an efficient harvest and return machine, is it possible that the market is discounting far more value than even a rapid decline would warrant? The entire investment decision comes down to your view on the timing of that harvest versus the timing of that inevitable sunset.